Hello everyone, this is Mulham from Mulham Trading. Today's video is going to be about liquidity and inducement. So those two topics are so important and they affect the way you choose your order block and fair value gap. And in this video, I'll try to make everything easier than any other YouTube tutorial that you watched. And we're going to cover liquidity and inducement. What are they and what are the common patterns and how can we use to trade better? Before getting into the video, make sure you watch the market structure analysis video since it's related to today's video. Let's get into it. So, liquidity is the fuel of the market. You will always see the market seeking for liquidity. And on the chart, it's a zone where there are lots of buy or sell orders or stop losses. We always need to target the liquidity and never to be the liquidity. And in order to master the inducement, which we'll cover later, we will need to go over the liquidity first, and I will show you briefly some patterns of the liquidity. So the first thing is a trend line. We all know what trend line is. It's a line that connects 2 points at least. This is the third point. We all know that above each of those points, there are lots of either buy orders or sell orders or stop losses, all of those. People are going to buy if this trend line is broken to the upside, and people are going to sell when the price reacts to this trend line to the downside, and everyone has stop loss above either this or this point. So this zone is high in liquidity. The other pattern of liquidity is equal lows or equal highs. This is one of my favorite patterns, and I always target when I enter a trade, I always target some equal lows or equal highs. Just make sure they don't need to be exactly the same. Just make sure that, so for example, we have those equal lows here. So we can see that this one is a little bit lower than this one, which is totally fine. You can see here. That's what we need to see actually. Keep in mind that if price just went a little bit lower, we won't consider this as an equal lows, even if it's just a little bit, because price went up, came down to take the liquidity, and it's worth the liquidity and goes up again. So this is not valid. If it's like this, then that's valid. This is a very important point. And this is more accurate when dealing with like you were here on the 15 minutes, you go to the 5 minutes, that's gonna be valid. But if you go to the 4 hours, it doesn't matter that much. So other types of liquidity, we have swing highs and swing lows. We also have the sessions highs and lows. So basically Asian session high and low, and then London session high and low, and New York session high and low, and the other sessions. My favorites one are the previous days high and low, and then we also have the equal highs or lows. So taking a look at this chart, 1 minute chart, we can see that price always seeks the liquidity. We can see that the market was going down here, price goes here, make a high, and then make another high, creating equal highs. Even though price goes down, but then creates a trend line here, a liquidity. Price goes up to take those equal highs right here, just took those equal highs and go down again after taking this liquidity and this liquidity. But after this up movement, we had equal lows here. After taking this liquidity, price went down to take this liquidity. So we can clearly see that the market was only seeking liquidity. That's what the market does. We can also see here that price made a trend line, price broke up. I can also consider this as equal highs, even though they are not equal. But as I said, this one is higher than this one, which means we had a liquidity here, price goes up, went down. Before taking this liquidity, it went up again, which means it adds more liquidity in here. So now talking about inducement. Basically, inducement is a trap. It's an order block that the market makes you think it's valid when it's not. Remember this, inducement forces you to get into the market to lose. On the other hand, liquidity takes you out of the market. So now instead of going over random examples, which will just make you confused, I'll show you different patterns or forms of inducement that occurs the most on charts. And after that, you'll be able to identify the inducement, therefore avoid it and always aim for the valid order block. So let's see the patterns. This pattern or form is the most popular one. It happens all the time, yet a lot of people make mistake with it. So basically, price was going up, making breakout structures. Then price make this high, go down, make a breakout structure here. A lot of people, just because they are in a FOMO, they don't want to miss the trade. They mark this as their order block right here, since they think price will come immediately to fill the. They don't see the big picture. They only see this. That's the last order block, and they feel like price is gonna come here and then goes up, and that's what happens. Price goes here, right here, goes here, and then reacts, but only to here, because price will go down. This is only an inducement. Price will go down and react from here. Why? Because the real order block or the high probability is the extreme order block, which is right here. You see where the breakout structure happens? We have this high happens here. This is the extreme order block. This is the valid one. Anything in between above this order block is just an inducement. It's just a trap for people to fall in. Even people with a lower time frame entry, when price gets here, they will switch to the lower time frame. They may see a change of character. Price will go down. They may enter here, and they are still out of the position because this is clearly an inducement. There is only one time that this inducement will work, and it's not an inducement no more. It's a valid order block. The only time this happens is when see this order block right here, this one. When this order block is already mitigated somewhere in here, like when you go to the lower time frame, you will see this order block mitigated. Even like here, if price goes from here to here, creating an order block and then just mitigate it immediately and then goes out from here, this is a valid order block. So now you don't need to, if this is already mitigated, you don't need to wait for it. You can enter from here because most of the time price won't go all the way here but react from here. Now this is a valid one. Just make sure you go to a lower time frame. If all the order blocks are mitigated and there are no fair value gaps, then you can use this one. So now looking at the second pattern, which I see a lot of time, and I can explain a lot of things in one time. So basically price was going up, a valid pullback, and then a breakout structure here. Now a breakout structure, this is our valid pullback. As we said, it's the extreme point between the breakout structure points. This high and where the breakout structure happens, this is the valid order block. This is where we want to enter. However, price does not reach this point and only reaches the first point. So now you can see that price respected this area and price goes up again to create another breakout structure. So see another breakout structure here. At this time, where is our valid order block? Should be this one, right? This is the extreme point or extreme order block after the break structure happens. So now it's the same one here, same one here. You can see that price respected again goes up, but then goes down to mitigate this order block, unmitigated order block. Why this happens? First, we can see that in this breaker structure, even this one played off very well and it could get us some profits, but this was not an accurate entry. That was not a right entry. Actually, this was an inducement. Price anyway respected it just to create more liquidity since we had those equal lows before. See? So we had equal lows. So whenever we have any type of liquidity before the breaker structure, we don't take that one. Even if this was the lowest point in here, even if it was the lowest point, we had equal lows, we won't take it. Even though price, this is the lowest point in this breaker structure, this is still invalid because we have liquidity just under it. So this is not valid. We see that price just made a small pullback, goes down again to mitigate this order block. So all of this was a noise. Price will finally come down to mitigate this order block and then goes all the way up. So now looking at this example, it's in the 1 hour, which I don't usually trade in, just for the sake of education. I usually do a lower time frame. So we basically see a breakout structure here to the downside, and then after that, and what happens between this breakout structure, we can see that we have a high here, and a high here. Then this one, you can have your stop loss above, but maybe there's an order block above here, somewhere in here, in the lower time frame, or there is one in here. But then we can see the price, this is an inducement. You can see that this is a noise that happens between the breakout structure. We always aim for the extreme order block, this one or this one. This one is just an inducement. We can see that even a lot of people will think that this is a clear order block and they will enter here, see how price picked out to mitigate an order block here or here and then goes down again. That's what happened. So inducement taken, price mitigate the extreme order block, the high probability one goes down. So in this example, we had a break structure, the bearish one, price goes down here. Now we have multiple order blocks. We have this one, we have this one, we have this one, then we have this one, the fair value gap. There are a lot of people, as when price will react here, they will immediately enter, which is very wrong. Or it's gonna go here and then have a reaction, a market structure shift, they'll also enter, which is also wrong. As we said, we're not caring about inducement, we're only looking for the highest point or the extreme unmitigated order block. So we have, you can see that this point was unmitigated, especially with the unmitigated fair value gap. So we're gonna mark this fair value gap. See, it wasn't mitigated. And then we have a fair value gap that was partially mitigated but not fully. We have a weird order block with the fair value gap, so maybe this fair value gap too. This is a valid one. But since we have one that is above, then we care more about this one. Just gonna give us a better risk to reward ratio since we're gonna have our stop loss here. If you enter short here and you're planning to have your stop loss just above here, that's gonna be a very risky because price may go and only fill this fair value gap and then go down from there. So that's a risky. And if you have your stop loss all the way here, it's not worth it. So for me personally, I won't take this. And for this one, doesn't have a clear fair value gap. I know that people may enter from this order block and they will say it's not mitigated, which is partially true. But this one is only an inducement. You know that price will go up here, takes the inducement, and then go mitigate this order block. That's what we all know. We don't truly know, but that's our system. That's the high probability setup. You can see that price takes this order block, takes this one, takes this one. If you have your stop loss just above this fair value gap, so this fair value gap, if you have it here, then you're stopped out. Price just went to mitigate the fair value gap and then go down from there. That's why we only care about the valid order block, not the one that's not mitigated. We don't care about inducement. This one, this one, this one, whatever. So now looking at yes, see that we have a breakout structure here, and then this is our highest point, extreme order block. But we can see that price partially filled that order block. So this order block is now mitigated. Now we could take an entry from here, and we can see that on the lower time frame, somewhere in here. And we can see that price respected it here. Just make sure when we are entering on an inducement, we should have our stop loss above the extreme order block. Just in case there is an order block on the lower time frame that's not mitigated, price may go up, just mitigate it very slightly and go back down. So in this case, we saw that price respected this order block from here, and then price made another breakout structure here. This is today, so a breakout structure. But then, first of all, this is our highest point. So this is our high probability order block. See right here. And it has a fair value gap too. So what makes this more high probability is that it's the highest point between the breakout structure, plus that we have a lot of inducement that needs to be taken, plus a liquidity right here. See those equal highs? We have equal highs, and then we have this unmitigated order block above them, and we also have an inducement here that has a liquidity above. So price may do this from here, may go up, just react a little bit, induce people to get short, and then price will take the this liquidity from here, and then just react somewhere in this order block or fair value gap, maybe even here before the order block, and the price will go down. So that's how I see it. This unmitigated order block has liquidity below. This inducement has the liquidity above, but this is not valid. This is for sure not valid. This is the only valid order. Remember, guys, everything I say here is not enough. You can't just take whatever in the video and be a profitable trader. You need to put the time, you need to practice, you need to, like the concept that we explained today, you need to go on the charts, identify them, and see how the chart reacts when there is a breakout structure. Try to identify where's the liquidity, where's the inducement, and where's the valid order block. Over time, you'll be much better in identifying order blocks and inducement. If you find this video helpful, don't forget to subscribe and make sure you like the video, and I'll see you next time.